Welcome to another exciting session of the Emergence Global Conference. I'm Rhythm Gupta, media anchor at Wholesale Investor, and I'm thrilled to be introducing our moderator and panelists for today's panel session on investing with purpose. In these uncertain times where economic instability, tech layoffs, and geopolitical unrest continue to affect the investment landscape, it's essential to understand what strategies work best for companies looking to raise capital. That's why we've brought together a group of distinguished experts from around the world to share their insights on the topic. Our distinguished moderator for the session is Chris Peralta, founder and CEO of Silicon Valley HQ. And we are delighted to have a fantastic panel of experts who will be sharing their valuable perspectives. Our panelists include Richard Webb, CEO and co-founder of Catalyze, Sean Cortes, founding partner at Hatch Private Capital, Brian Canahan, Senior Trade Director at Victorian Government of Australia, and Jeff Krenz, advisor and board director to growth companies, entrepreneurs, and investors. So get ready to join the discussion. Let's hear from our esteemed panelists on how best to fundraise in this current environment. I'm sure you'll find this session informative and thought-provoking. Over to you, Chris.
Amazing. Thank you very much, Rhythm. And it's great to see you. And thank you for our panelists for joining. So we are going to have some fun today. I know fundraising is hard, but we're going to get rid of that D and make it fundraising. Welcome everyone to Ask the Expert fundraising series, discussing the fundraising with purpose. So my name is Chris Peralta, for those that don't know me. I am the founder and CEO of Silicon Valley headquarters. We are honored to work with our partners. Let me just share my screen for a second. Here we go. We are honored to work with our partners at Wholesale Investor. And also we run actually a 2-day Investor Ready program called Crisp Growth Labs. So if you want to learn more about that, please reach out to the amazing team at Wholesale Investor. But before we start, let me give you a very quick background who I am and why I created these Ask the Experts series. I'm a bit of a visual guy, so let me show you one slide and one quick video. Back in 2012, I started in corporate at a company called Nokia. I closed hundreds of strategic and app deals with companies like Dropbox, LinkedIn, Uber. In 2012, I landed in Silicon Valley from New York, and I was immediately hooked, with the culture, the innovation, and all the smart people. In 2015, I created Manila Valley, helping Filipino startups. I'm originally from the Philippines and was one of the first mentors. I was very lucky at Google Launchpad, where I mentored, you won't believe it, more than 300 companies or startups there. It was amazing. This evolved into running my accelerator programs for the Korean government, Mexican government, and organizations from 20 countries around the world. I love helping people, but I just wanted to figure out how can I make it scalable and sustainable. So I started Silicon Valley headquarters, and its DNA is primarily on online mentoring, but has also evolved to be customized for universities and other organizations, particularly in emerging markets. I'd love to share a very quick video.
Silicon Valley HQ is an online business incubator specializing in providing mentorship and access to Silicon Valley insiders who can help you pitch, finance, grow, and exit your startup. My name is Chris Peralta, and I started mentoring startups at Google Launchpad in around 2016 and went on to run my own accelerator and immersion programs with founders from over 20 countries around the world. During that time, I discovered the single most important ingredient to a startup success: having the right mentor and knowing how to leverage that expertise at the right time. That's why I set up Silicon Valley HQ, because I'm a curated connector. I like to connect entrepreneurs to the right Silicon Valley experts at the right time. I've established relationships with hundreds of tech mentors through executing deals with companies like Dropbox, Uber, Facebook, and many others. Whether you need to refine your pitch, meet angel investors, or find the right deep knowledge expert to bring your tech innovation to life, Silicon Valley HQ gives you access to proven playbooks, matter experts, webinar series, and a virtual pitch session with Silicon Valley investors that you can access from anywhere in the world. Our mission at Silicon Valley HQ is simple: to build a global startup ecosystem to help entrepreneurs all around the world start, grow, and exit their business. Go to siliconvalleyhq.com.
All right, perfect. So it brings us back to why we are here today. We have a panel of experts who will give their insights on the investment landscape. I will be the moderator today, and I'm super excited. So let's meet our amazing panelists. First, we have a veteran in acquisitions. He's led more than 100 acquisitions, joint ventures, and corporate investments, including 3 multi-billion-dollar transactions. He moves between his home in UK and US, and I love his passion towards mental health. Let's kick off this powerhouse panel with a bang. Jeff Krentz, please introduce yourself for 60 seconds and tell us a fun fact about Jeff.
Well, okay. Thank you, Chris, and thanks to the audience for tuning in. My name is Jeff Krentz. Why don't I give you my career background very quickly, and then maybe I can go for the fun fact. I started my career as a management consultant. So I worked for a company called Bain & Company, which is now an international consulting firm, but at the time it really was just a handful of offices in the US. So that's where I developed a strategy background. I eventually made my way to Silicon Valley back in 1993, so before most people were even familiar with the internet. And after grad school, I worked for a small merchant bank advising small and emerging growth companies and raising money for them. I then, during the first internet era, co-founded my own startup and raised about $20 million of venture capital. And then for the last 20 years, I worked for a big corporate, both in the US and the UK, as head of strategy and M&A. And I'm not so sure this is much fun, but the one fact about me is I actually was a competitive runner when I was younger, running for the Nike farm team.
Amazing.
There you go.
Well, welcome, Jeff. Our second panelist is the Senior Trade Director for the Victorian Government, but based in Silicon Valley. He's responsible for managing the North American trade engagement strategy and assisting Victorian companies establish new export markets and expand exports in the Americas. We'll try to get him to help New South Wales as well, by the way. Mr. Carnahan, please introduce yourself for 60 seconds and tell us a fun fact about you.
Thank you, Chris. I appreciate that. I have worked with New South Wales companies in the past, when I worked for the Australian Trade Commission about 18 years ago. But I've been working with Australian companies for about 20 years. I was with a startup in the ag tech space back starting in about the year 2000, and I wouldn't say they were a successful startup. So I do know some of the things that you probably shouldn't do out there. But I've probably helped over 1,000 companies in the last 15 years working for the Victorian government, and it's across a lot of different spaces, everything from defense and aerospace to food and wine to tech. And being based in San Francisco, a majority of the companies that we actually support are tech-based companies, and whatever that means, whether it's ag tech or cyber tech or fintech, it covers a wide range of activity out there. But I've seen a lot of things that the companies have done correctly and incorrectly as they've gone out to raise their funding. I want to actually do 2 fun facts. One is, as most of you can tell from my accent, I am not Australian, though I've been working for the Australian government and the Victorian government now for combined about 18 years. You probably hear a Kansas twang in there because I did grow up in Kansas, but I've been in the Bay Area for 38 years. My other fun fact, piggybacking on Jeff, I was never a competitive runner. I have run a couple of marathons, but definitely I would never say I was competitive in those marathons that I've run. So anyway, thank you. I look forward to the rest of the panel.
Amazing. Well,
Great.
welcome, Ryan. Next, we have the extraordinary Sean Cordes, business founder, investor, and entrepreneur. His expertise is family office fiduciary. Recently, Sean raised more than 140 million in the US. Please introduce yourself, Mr. Cordes, and tell me one fun fact about you.
Yeah, well, thanks, Chris. Pleasure to be here and amongst this esteemed group of panelists. So, hi, guys. Great to be here. So, keeping it simple, my whole background, it explains me, is I'm an accountant, right? I started in accounting very early on in private clients. My first client I worked on was Rupert Murdoch's family office, and then I was hooked into working with those sorts of guys. So, my whole background has been around tax, structuring, asset protection, succession planning. But then I got the hook of business, and on the buy side due diligence started helping family offices from overcoming all the mistakes they were making. And I found out that it was a lot more rewarding financially to participate in the deals rather than being an advisor to the deals, charging by the hour. So I think that led me into founding my first business, coming into a co-founding role, which was bringing German science into a health business in Thailand. And as you mentioned, last year, I lived out of a suitcase crossing all over America, raised $140 million to get up a dental aggregation business. But I think, as mentioning family office, I've got a family office advisory firm where I still provide those corporate advisory and fiduciary services to them. Really, it's problem solving, because investing directly in private assets goes with some real trials and tribulations. It's the famous J curve, like the volatility of markets and everything that goes wrong. So I've had a lot of experience around that. Fun fact, well, my hair's still wet from the surf this morning, so surf's up. I'm a bra boy. That has nothing to do with women's apparel. It's beach. So I love my surfing. That's my escape and my meditation.
Amazing. Welcome.
Beautiful.
Sean.
Great.
Our last amazing panelist is a serial entrepreneur. He has dedicated his own resources over the last 30 years to support the next 8 billion one-man corporation's success in solving important global problems. Today, Catalyze, I believe, has more than 125 people in 24 cities.
24 cities, yeah.
Richard has held more than 170 company board directorships in 29 countries, which is phenomenal, and actively supporting new technology startups globally. Mr. Webb, please introduce yourself in 60 seconds and a fun fact.
Great. Thank you very much, Chris. And to the other Midwesterner on the panel, I was born in St. Louis and left New York after 8 years in New York in 1984 to live all over the world. So I've been fortunate to have lived in all continents working for Pepsi. And then I found Sydney and fell in love with Sydney. And the only way to stay was to be an entrepreneur. So 10 ventures later, 2 IPOs and 8 trade sales. And raising about $500 million over that 20-year career, I decided at the insistence of my children to focus on the third phase of my career, which was supporting the entrepreneurial community. We set out to solve a fundamental problem, which was the high rates of failure of entrepreneurs, and more importantly, whether or not we were going to survive extinction as a race if we didn't get those failure rates down. So we spent the first 2 out of the last 9 years understanding what the problem was and how we could solve it. And the way we've addressed it is that entrepreneurs need capital and insight to succeed. And that capital comes in the form of human capital and financial capital, as well as insight and strategic guidance to succeed. With regard to our financial capital practice, we have 5 capital practices: customer capital or revenue, brand capital or corporate sponsorships, taxpayer capital or government grants, debt, and investor capital. And so we've looked at a holistic approach to capital. That's it for me. I could go on and on about this, but fun fact for me, I do have 6 kids that have been born all over the world, and I have 2 grandkids. And largely I'm doing this for them, who have all growing up with a manic father become entrepreneurs. So yeah.
And Richard's also based here in Sydney in Bondi.
Yeah. Yeah.
It's in New South Wales, not Victoria, by the way, guys. Okay.
Yeah.
Before we start, I just wanted to, I know you guys are eager to hear our insights from the panelists, but this is an amazing, I just want to set the tonality here. It's an amazing, landscape view of Australian capital in 2022. But just a few things to note here. There is money, $7.4 billion invested last year, 712 deals. It is a 30% fall on 2021, but less than the global drop of 35%. We are breeding some unicorns, which investors love to see. Investment has grown 5x in 5 years. And we're starting to see more female founder deals, although if you break it down, there's less funds invested in them, in females founders. We're also seeing some, by sector, fintech and enterprise SaaS is growing strongly. But the big difference is these mega rounds are going down. And it seems like there's a growing amount of early stage capital here in Australia. Top three funds, I believe, raised more than $2 billion and they want to focus also on early stage, Airtree, Blackbird, and Square Peg here in Australia. So let's start with Sean or Richard, since you're based here in Australia. Broadly speaking, what is the funding landscape on the ground like in Australia today?
You want to go first, Sean?
I'm happy to kick off. I think what it's like here, Chris, is a global thematic at the moment. I think that it's really the appetite, I think, in private money is for more credit deals at the moment. People are thinking credit is safer at the moment with all the volatility in the world at the moment. So I'd say there's some happiness to actually do some deals because valuations have come back. That's good. But people are thinking when they're putting equity in, when they want to fund a business, they're doing it more under a debt instrument, a safe note, a convertible, as opposed to equity, because there's still so much uncertainty around capital. And I think it's just really tough to raise capital. And I think that, the funds they've got some challenges because you can't sit on a pool of money and charge 2% without deploying it. So, they've actually got to find some deals. So I think it's going to be interesting for what they do, but they're going to be in the mature end of the market. They're not going to be at the early stage. So I think for growth capital, the landscape is really, really good. They'll be a lot more aggressive around. I think we're going to see more of venture debt participations again versus equity. And I think otherwise people are reserving dry powder, waiting for some real pain in markets. Like stories like Silicon Valley Bank actually is what people have been wanting to see. And I think people are happy to see it. But otherwise, I would say it's a lot easier to raise money from high net wealths and angels on blue sky as opposed to EBITDA. The funds, institutionals, big family offices are just sitting back more cautious than ever. So they're my key observations.
Right. I'll add a little bit to that, only because we've had, the most interesting last week in the world, thanks to SVB and whether or not the small regional banks around the world are as well capitalized as they need to be. But I would say generally from our thoughts on the investment community right now, investors we are seeing a massive decentralization of society. Every investor has a different profile. And I think to think that all investors are sitting somewhere on a two-dimensional risk return scenario is wrong now, because they have ESG requirements, they have diversity requirements, they have a whole range of stuff. And I would say every investor today has a fingerprint. So if you are looking for an investor, you're looking for an investor that is aligned with your purpose. And to assume that you can take the same pitch to every investor in the planet and only strike gold 1 or 2% of the time, that's just an inefficient way of doing things. We've got to stop thinking that way, that investors are different, and we as entrepreneurs are different, and we have a different reason to exist. And it's about the matchmaking that goes into finding those people. The second kind of big trend that we're seeing as the world kind of diversifies, we're seeing kind of centralization fail. And I know it's a tenet of shareholder capitalism for many years, but FTC failed because there was fraud, but at the end of the day, it was a centrally controlled exchange masquerading as a decentralized blockchain, a new currency. So at the end of the day, Silicon Valley Bank was a centrally controlled environment. So the question is, as the world goes to a decentralization platform, and we think more decentralized, every individual has a different need as an investor. And investors increasingly on the other end of the spectrum are looking at hybrid deals. They want to put some in debt, some in equity. They're looking at this. They're still supportive. They still think there's massive opportunities for great returns, but they are thinking differently about how they contribute to those businesses. And I guess what we've spent most of our time is trying to understand the unique fingerprints of investors and the unique fingerprints of entrepreneurs, and making sure we put the right people together so we don't waste as much time. So, yeah.
Totally makes sense. And we can go deeper in some more conversations later on, but I just wanted to go broad strokes. I have in my head, and I know the audience does as well. Now, across the pond, when I saw a Crunchbase article, Q4 last year, investors put like $36 billion of working capital in all stages of companies, which is a 63% or so decline year on year in the US. Declines, I think they're sharpest at the later stage. What is happening? Same question to Brian, Jeff as well. What is the funding landscape like on the ground there in the US as of today?
Why don't you start, Jeff?
Okay. It's a bit uncertain right now, more uncertain than it was. So capital is not flowing as freely as it has over the last 3 years. But we also have to, I feel like we have to keep this in perspective, because you can look year on year and look at a funding decline of 60% year over year in the fourth quarter. But that was after a manic year of quite liberal investment. And so I think the best companies are still getting funded. Capital has to be deployed, to the point made earlier. I think in the US, over the last 2 years, venture firms have raised $315 billion in the US, and it has to be deployed. So I just think that that investors are getting a little bit back to fundamentals, right? So and what's happened over the last 3 or 4 years is that that investment has been disconnected from the fundamentals, and as a result, valuation spiraled a bit out of control, and now we've got a bit of a deleveraging process around valuations. So it will be tougher to raise capital. Investors, I think, will be slower to make those investments, but the best companies will still get funded, and there will be plenty of capital to go around. Yeah. Brian, I don't know if you disagree or agree.
No, I agree with that completely. And I actually grab onto the last statement that you said, that the best companies will still be funded. I think the competitive landscape has changed a lot. It's a lot more competitive. And companies of venture capital companies are certainly looking more at the details of what they're investing in. Jeff had mentioned that, there's been a plethora of funding out there, and probably in some companies that maybe shouldn't have been funded in. So I think that they're starting to look a lot deeper into the plans and the business plans and the marketing plans and everything about the founders, also about what their criteria is, what their experience is. And so there'll be a lot sharper eye before they do in the investment. And that's where it comes down to the best companies that Jeff mentioned. The best companies will have all that in place. And that's the companies that are usually successful in the long run anyway. And I guess that's what the money's looking for, though, is that success so they can exit at some point.
Yeah, no, we had Go, please.
Oh, sorry, Chris, please.
No, go ahead.
No, I was just saying, look, investors, I think, are just, as I said, I think are going to get back to some of the fundamentals around investing, which are to answer the questions, what problem are you solving? What's really unique about your product or service? Do you have a thoughtful perspective about existing competition and emerging competition? How capital intensive is your business? Are you the right people to lead the organization? Is your business plan real? Just like all the fundamentals that everyone knows that got largely, I think, discarded over the last 3 or 4 years. And there was a lot of thematic investing and a very much a herd mentality, which is a sign of some bubbles, which is what I think we experienced certainly in Silicon Valley over the last few years. And there's some bloodletting that's going on right now. But innovation has never been greater in my mind. And I'm incredibly excited about what's going on in the US and elsewhere around the world, because I work with and I see startups globally. And it's never been a better time, I think, to build a company. And there's a ton of empirical evidence to suggest that the best companies and the best returns for investors happen during tougher periods.
We had our Crisp Growth Labs on the weekend, and we had some really good insights. Some of our speakers, friends of mine in Silicon Valley, were also saying the same sentiment. There's a lot of money out there, but one of the key things is that investors are more realistic. He was saying, tell your story through numbers, and take an engineering approach to fundraising. But what about for those, and Sean, you talk about blue skies as well, but what about those early stage companies in the audience who don't have those numbers?
Chris, do you want me to just make a comment when you're talking about the like blue sky?
Yes.
So I'll give an example, right? So I'm looking at a new drug at the moment that's done 300 clinical trials around preventing the progression of Alzheimer's and dementia. It's super exciting. And to what Richard said before about, it's the matchmaking exercise and actually fitting for purpose what families, and I think particularly in wealthier families, looking intergenerationally around engaging next gen and saying, it's not just about the money, it's actually having the impact and purpose for what we're doing, right? It's a topic we're talking about. So that's going to be a really easy capital raise, because people just love the idea, and the valuation is really uncertain. We have no idea. There's going to be hundreds of millions of dollars that are going to go into clinical trials down the track, right? And that's going to have to withstand valuation metrics of some of the world's biggest funds and institutional investors, right? So it gets really robust. But if I reference another one, sadly, for one of my investments, I attended a voluntary administration meeting yesterday, right? And they'd raised $15 million in the last 18 months. And they were burning $600,000 a month. It's a cybersecurity business, had, government clients, big banks globally, all the opportunity in the world. But when it came down to it, and they were like going, we've got the next contract, we've got the next contract. And they just needed that next tranche of capital. And while there was a huge appetite for it, they couldn't get the deal together in time. Right. And everyone that was looking at it was now saying, right, we want to see the metrics around the sales pipeline and conversion, right? You pitched a forecast to say 12 months ago you were going to be here. You failed on that. So they're going, right, your assumption is that you would see a customer and it would convert to a paying client in 3 months. Well, the fact is it's 15 months. And 15 months in the way you're burning money is presenting a $10 million funding gap. So people got really nervous. So I think to the comments made about, I'm an accountant, I keep mentioning it, right? So I look at the numbers. I want to see the forecasts. I want to see the track record and show me what you budgeted, how you achieved on that, and I'll apply it going forward. And I just think that those processes are far more robust at the moment. It's again, right, to raise the first $500,000 on a really good story with that blue sky thinking is you can still pluck a valuation out of the air. It's a 3 Fs, friends, families, fools. I would say be more strategic than the 3 Fs, and I would actually find, aligned investors there, right? It's actually saying if you're in fintech, you want to find a good, like corporate lawyer that's had the experience in payments and regulation and processing, right? There's lots of lawyers that make good money, and you want to be their ally. Like look for those groups. Like that might be the best first $100,000 you raise. But look, I completely agree with the comments around. That's why I was sort of referencing, with those examples about the emotional investment, early stage versus then more mature it gets. It's all about the numbers. It's the engineering. It's pulling out all those forecasts in detail.
Yeah, absolutely. And I think another investor the other day said that pre-seed might be easier if you have a great idea, some validation without some numbers, because there's no expectations, right? You don't have to get these growth rates, these revenue growth, et cetera, et cetera. You highlighted two key things that I thought was really fascinating. One was financial health. That's really something I believe startups, and I don't really look at at all. Two,
a good CFO.
Yeah.
CFO.
Two is timing for fundraising. A lot of people founders expect that it's going to be tomorrow that we'll be able to raise, but it takes months. And there's due diligence. You have to get all your ducks in order. It may take.
Can I comment on this one? Right, this is what I see too often, right? And I'm sure other people have seen it. This company, actually, the problem was in their raise is they concentrated too much on the fees. Right, and they were trying to budget and being stingy on paying, a party around fees, and that delayed the capital raise process by months. And then they actually had a disengaged and a non-aligned partner in helping with the fundraise, right? And who cares about fees now that they're in administration, right? It's good because the IP is really valuable, but it's the part of it, right? I think you need to be. You just need to be, really, really honest about that too, right? Because everyone will tell their stories in the small startup phase about, you'll see, the smartly dressed investment banker that will come in and promise the world, and you're going to retain me on $10,000 a month. You're going to pay me a 5% commission, and I want warrants in the company, right? And 6 months later, they haven't raised a cent. Right, so it's a real challenge around these stories. But I just go you have to be. I think for the startup community, you really have to do your diligence around it. Don't you've got to actually say to these people that are helping you, you've got to go and talk to their clients, see who they've raised money for, do the due diligence, and say how'd they actually go with it as well.
And that takes time.
It does. You want to think from start to finish. It's you want to put it's a minimum 6 to 9 months. You could do some deals last year in 3 to 4 months, but I'd say 6 to 9 now. Yeah, conservatively.
I know we can delve deeper into too many topics here. I just want to throw something out there for each of you. Can you answer what are your top 3 criteria when you're looking at partnering with a startup or investing in a startup? What are the top 3 criteria you look for? Brian, do you want to start?
Yeah, well, Chris, my perspective is going to be a little bit different because I'm not actually investing in companies. I'm supporting companies. So I would actually probably be at some point referring them to Richard or Sean or Jeff to get the expert perspective on what they're trying to do. But when I see companies, I'll answer a little bit differently. So the companies I see that are successful actually deal in reality, and it goes back to those fundamentals that Jeff was talking about. 2 things is I was doing a presentation at an incubator in Melbourne, and the incubator companies that we're pitching to kind of were angry at us because we'd got some funding for them to come to the US to TechCrunch, and they were thinking they'd come to TechCrunch and they would say it was easy to raise capital in the US because the streets are paved with gold. So the reality check is, it's not easy to raise capital. You're going to have to be here for a long time. I think Sean mentioned that, it's going to be 6 months, a year before you get to the right investor. And I think someone else mentioned that earlier, is that you have to find the right investor. So companies that have that reality about who they're looking for, make sure that it's not long. And the other reality that I look for is that companies will say, well, this is the best technology in the world. This is the best product in the world. And they come to Silicon Valley and there's 5 other companies doing something very similar or better. And they haven't done that reality check. So if I was that, I'd want to make sure that those founders, were thinking about the reality of what they're trying to do when they come to the US. But the actual answer to the question, I'd probably leave to the other panelists.
Well, even Brian, what are the top 3 criteria that makes you recommend the companies to?
Well, one is that they have to have some financial backing where they have to be here for a certain period of time. They can't fly in and raise capital. They're going to have to be here at some point to be able to do that. So if they're not able to fund that and seek out companies here, that's definitely another one. The other thing I look for is, do they have a solid business plan? And I'm not saying it has to be their final business plan, because there's pivots along the way, as everyone knows, but they have had to do some serious thought that they have a serious business plan, that they have some type of a growth in the future. And then they have to develop a really solid pitch. And the pitch, sometimes, you have your 30-second elevator pitch and everybody thinks it's the same thing. But if they have a pitch, depending on who they're speaking with, is it investor? Is it a company they're seeking funding from? So they have to have that reality of understanding, their business plan, that they've got to be here for a period of time, and they've got to prepare a good, solid business plan that makes sense. That not is the final one, but it's something that they get in front of an investor that the investor doesn't think it's silly, and they don't get upset with me because I've referred them to me, because I don't want to burn that contact. Because all the investors, you have so many people coming to you, you get swamped with those types of things. I tried to avoid that.
Okay, so those 3 things is you have to have presence on the ground and sustainability there. 2 is your business plan, a solid business plan, and 3 is a effective story pitch. Yeah. Perfect. Yeah. Jeff, what are your 3 criteria?
For me, it's first and foremost the product or service. Does it elicit a reaction of, wow, that is really unique. I haven't seen something like that. So that's the first one. The second is really a really good understanding of the market and the market dynamics, and a really solid business model. So that's number 2. And then I'm going to cheat a little bit on the third. So I'm going to say that the team is absolutely essential, but Richard can attest to this, because even in the best of circumstances, being an entrepreneur is the toughest thing that you'll ever do. Is likely to be the toughest thing that you ever do. And when I think about the team, the most important thing for me are the intangible characteristics of that team. Do they have an obsession to detail? Do they have a capacity for really intense work? Are they good listeners? Are they resilient? Do they have high emotional intelligence? Do they have personal integrity? And do they have really good communication skills? And then finally, and this might be a crude way of saying it, so please don't get offended, anyone on the panel or in the audience, but do they get shit done? Those are the characteristics of the team that are absolutely essential. And team might very well be the most important thing that I'll look at.
John?
Yeah, look, I echo a lot of those. I think, beyond the unique, sexy product, service, whatever it might be, I think, number 1 there, it's where I always start, is the competitor and market analysis. So often you do hear it's wonderful, and you go out there and you straight away discredit the team because there's something equivalent or better or something out there. So and I always start by finding someone. If it's in health, I'll talk to the scientist I know that's in the field. If it's in fintech, I'll talk to, someone that's in banking that knows it really, really well, that helps me at that first one. So I'd say that absolutely, because people will pull you apart on that. And in an investor Q&A, people will always do it. You get on the Zoom call and you've got the investors there, and the first thing that comes out of Q&A is do you know about this? How do you compare to that? So you've got to be all over that. I think the other one is, and it's right to the point here, specifically around being ready for the fundraising. is I'm just going to say it's like data room, is get the data room together with everything that's in there, right? Get it all together so that you make due diligence easy for people. If you're presenting it in a manner that makes it hard for people to make an investment decision, forget about fundraising. So I think then, and that really goes to things in there critically. It's legal structures, the IP, the key contracts. I want to know, what's the management team? We know they're great people. I validated that, but what are their contracts, right? What's the, what do the terms look like? And most often there's just huge gaping holes everywhere around that where you just lose alignment. And then I think then it is on the team members specifically, because I've invested money in businesses where, again, shit has hit the fan, excuse me, and you find the founders, the management team get spooked and they walk away from it and they start blaming everyone else. So I think, the word was mentioned before is resilience is good. I think the real judge of human character is when something goes wrong. And as a founder, I can tell you I'm very familiar with the fetal position, right? Because there are some really scary moments where you think, oh, I'm going to end up, being sued here, or, and you're going, the fundraising's not coming together, or you lose a key, there's just a loss of momentum, you lose a key staff member. So I like to ask the question and saying, do they have, I don't want to see the narcissist, right? Narcissist out, right? But a good team that show resilience and humility, right? Will they take advice? Because again, great founder, they can be a great product or service ambassador for the business. And then the next challenge is getting them to step aside and going, you can't do everything. You can't do sales. You don't understand anything about the detail, right? You're a hunter. You're not a cook, it's those sorts of things. So they're my top three. Yeah.
Got it.
Beautiful.
Richard?
Great. Yes. I'll start with the fact that we have a huge amount of companies we talk to and communicate with every month. We get about 200 applications a month. We meet with 25 of those. We give an hour to 25 of those, and we generally choose about 3 a month going forward. So it gives you a rough idea of the filtering process we go through. What we're most interested in and what we're really focused on is the impact on the individuals of humankind. And so we are focused on humankind's needs. We built 10 vertical practices around health, food, shelter, all what I call basic humankind needs. And we fundamentally look at first and foremost, what is the problem you're trying to address that humankind is facing? How big is that problem and how important is that problem? The second question is the solution. How novel is the solution? And does this have the capacity to impact the most amount of people? So is this going to solve a problem for three billionaires, or is it going to solve a problem for a lot of people? And so we're looking at the capacity to solve a number of people's problems. And last but not least, it is the alignment of the entrepreneur, the founding and the management team's ability to have a true purpose, that why they will keep doing this forever. And this kind of cuts the take of resilience. At the end of the day, if someone in your family has died of cancer and you're focused on a cancer solution, you're probably going to be doing that for the next 20 years of your life. You're not going to give up. There are no hurdles in front of you. And if you don't have that alignment, the first hurdle that entrepreneur focuses on, they quit and they move on to the next thing. So we're looking deeply at that. So those are the fundamental 3 things. If you can address the size and importance of the problem, the novelty of the solution, and the capacity of the management team to be resilient and to fight forever to solve that problem, that's what we look for.
Got it. Awesome. Now, we hit on valuation, and it's becoming an issue right now. How do founders value their company? How do they reach a number from your point of view? Have you used any tools or formulas? Do they need to use any tools or formulas? What are your thoughts? And I know it's there are different stages of companies, but what are your general thoughts on how to value your company to investors?
Mate, do you mind if I kick off on that one, Chris?
Yeah. Yeah.
So look, it's like I go again. I kept saying I'm an accountant, right? And I've done expert valuation reports in courts and in disputes and everything. So I'd say for me, I always want to come back to a discounted cash flow, right? So I go in financial modeling. When you do it, go beyond just the, a profit forecast, do a profit forecast, a cash forecast, and a balance sheet. It all comes together in what's called a three-way financial model. And you can apply discount rates to that for equity investment to kind of get a sense of it. That being said, the reality is there's a couple of realities. And the first one is it goes with the ask and the need of a business. So someone comes to you and they go, I need to raise $2 million. And you go, well, you probably don't want to give up more than 20% of the company for that. So they kind of, the pluck out of the air becomes, well, I need to value the company at let's call it 10 million pre to be able to raise the money. So I think it comes back to the ask. Valuation so often comes back to the ask early stage. And I'm aware a lot of your audience are early stage here. So that's one. The other metric that I hate, and I think we're going to see this knocked about and disrupted, is particularly in SaaS businesses and fintech type businesses, et cetera, where a lot of the capital goes, is valuation done on multiples of annual recurring revenue. And you do see some benchmarks around that, and you can look at like real estate agencies forever. People will value, right? They'll go 80 cents on the dollar for the value of your rent roll. And like, it makes no commercial sense if you're in court, arguing it. But you do see a lot of benchmarks around that. So yeah, you have to have an awareness in the market of referencing some other transactions and going, well, we saw a big trade sale and it was done on this basis. And you've got to say, well, we're smaller, we're higher up the risk curve and everything, and sort of work backwards. So, ultimately, I'm saying I want to see the DCF from a proper financial model, but the reality comes back to starting with the concept in that blue sky. It's going to be about how much money you need and how you have to strike the valuation to not give away the whole company, right? And then it's just some reference points to other market stats around that. Like ARR is one. It's a pet hate, but deals get done on it.
And Sean, you're an expert here, though. For startups that don't have the capital to get your services or have a professional do it, are companies like LegalZoom and Legal Vision and other companies that are providing those services, and there's a subscription fee associated with it for legal and accounting services, are they adequate to help with these types of? Have you seen any firms like that?
Yeah, it is. And look, I'm a really big fan of using those online tools to start with. So, for example, you can actually, buy off the shelf a shareholders agreement and work it up to 80%. And then you can engage a lawyer to finish off the last 20%, right? So that saves you money. But again, I think it comes back to if you're going to be an entrepreneur, you want to have an entrepreneurial accountant and you want to have an entrepreneurial lawyer. So I used to work with startups when I was running a chartered accounting firm, and sometimes my partners hated it, but I'd also do deals based on sweat equity deals. So I'd contra and I'd say, well, here's my usual rate, right? Let's offer payment terms when we raise capital, right? And I'll put a risk premium on it, or pay me half the cash fee and I'll take the balance in some equity. Right. So if you've got advisors around you that aren't prepared to risk their fees into your business, are they the right advisor? Do they believe in you? Right. Or alternatively, if they're not believing in you, have you got the right business plan? Have you got the right business model? If your very own trusted advisors don't trust to invest in you.
Got it. Okay. Now I know I have so many questions here. I know you guys have so many other thoughts. I know Jeff has to leave shortly, but Jeff, on an M&A side, what's happening in that space? Are you very active in M&A deals? I also saw an interesting article, which I sent to Richard, that there was this pileup of cash for SPAC deals as well. What's happening in the latest stage, IPOs, M&As? I know it's a very general question, but any insights for the audience thinking about going public, that are thinking about selling their business? We have a few trade sales that we're looking at as well, that they want to sell their technology. What's happening on the M&A side of things?
It's slow.
Sorry, there's a lot of feedback here.
I think your computer's finally working. The audio.
Okay, let me.
Okay,
Perfect.
let me mute my computer and just speak on my phone. Hopefully that worked out.
Okay. Yes.
Perfect. So the market has definitely slowed, but again, it's a little bit like on the fundraising side. It's slowed to levels that are probably more familiar with earlier periods of time. Now, for later stage deals or for big transactions, the debt capital markets are not frozen, but they are very soft. So you're not seeing a lot of big transactions. For most people in this audience, which are startups and growth stage companies, there's still transactions going on. We're starting to see, and I expect an acceleration of consolidation going on. There will be firms that will fail, that were funded, that didn't have solid business plans, that maybe have some IP, some interesting clients, but are not sustainable as standalone businesses, and they will get sold. There is a voracious appetite, depending on the type of business, from corporates who want to, either develop IP, particularly technology companies, particularly, not surprisingly, in areas like AI, but not exclusively in AI, that are acquiring technology businesses. So the short answer is it's a bit of a mixed bag. It's not as vibrant as it was, but the market is not closed. The IPO market is largely closed for now, but that's a common feature of the IPO market. Windows open and windows shut, and even the best firms sometimes have to wait to go out when markets are a little bit more receptive. So that's basically what I'm starting to see in the market. But I do think that you'll see an acceleration of consolidation. Maybe not as much M&A as in 20 to 22, but a continuation and definitely a winnowing out of the winners and losers.
I don't know the percentage breakdown, Jeff, of the M&A from an acqui-hire standpoint versus the IP or the technology standpoint. Is there more inclined nowadays to which one?
That's a bit of it ebbs and flows, and this is where Brian actually might have some better visibility than I would. I still think the acqui-hires, even if you hear about them reasonably frequently, there's not an awful lot of that going on. At least I'm not seeing it. If it's happening, I'm sure others, might be seeing something different. But I don't think that happens in more than 10 to 15% of the cases.
I'm hearing more also, Jeff, on the secondary market. So in next rounds, founders needing some capital, doing some, sale, during the round and the secondary market. What's that market like at the moment? Is there an appetite?
Yes. And again, every market has slowed down a bit, but particularly from 2019 to 2022, there was the establishment of a lot of growth equity firms. Particularly in the States, that have raised huge sums of money. And so they need to deploy it. They've got an appetite to do a secondary. They probably want a combination of primary and secondary. So they still want founders and leadership teams to have skin in the game, but they're willing to write big checks to take meaningful stakes. So that's not happening, of course, in the traditional venture community, but definitely in the growth equity and the private equity community.
And Jeff, you're working on a mental health company at the moment.
Yeah.
And I guess it's a big issue globally. I remember back in the day I was working with Momentum, and one of those crazy statistics: 1 in 3 kids don't have access to mental health care. And there's a growing number of globally mental health issues around the world. What are you guys doing? I remember it was preventative. Do you want to share quickly what you're working on right now? It doesn't have to be that company, but and where.
Yeah, no, I'm happy to do that, and thank you for asking about it, because it is something that I'm incredibly passionate about. So I work with a UK, a small listed business called Kooth, which has been around for about 20 years, and they provide digital mental health services to the NHS in the UK, and they've now expanded in the US. As you said, we've got a crisis in mental health across the board, but particularly youth mental health. And I read a statistic from the CDC here in the US last week that 57% of young women, teens, have persistent feelings of loneliness or isolation, and 30% have considered suicide in the last year. So it is a staggering problem, and there's a huge supply and demand issue. And the only way, in my mind, that we're going to start to tackle this problem is through technology and early prevention or early intervention. And so that's what Kooth does. And actually, we just recently received word, and it was publicized by the California Department of Healthcare Services, that Kooth will be the platform for all 13 to 25-year-old teens and young adults in the state of California that want mental health support. So there'll be an interesting further announcement about that tomorrow from the Kooth team.
Amazing. And where can they get more information about that, the audience?
Oh, thanks for asking about that too. You can go to Kooth.com, Kooth.
Fantastic. Thanks, Jeff. Brian, Richard, for those that are thinking about raising capital overseas, like, everyone wants to go to Silicon Valley, wants to go to the US, but, we also have Asia. Like I know, Sean, you're working with a lot of family offices in Asia, but for those that want to go to Silicon Valley, and I was at an event last night at AWS, and a lot of people have experience going to Silicon Valley and looking at raising capital. What's your thoughts there, or generally, Brian, on the next steps? And then Richard, I'd love to hear from you as well. Some of your companies, how they approach international investors from Australia.
Right. Well, you're right. Most companies think Silicon Valley because that's where a majority of the capital is, and so they say, well, it comes to Silicon Valley, without realizing how uber competitive it is. And so now we've seen some companies have some success going to Boulder or Austin, secondary markets, regional markets, where most of the venture firms have set up offices anyway. And when they get into that, it can still be competitive, especially get to someplace like Austin. But that's certainly a place for them to head and do some business. It's much more economical for them to set up and spend some time in Boulder, Colorado, or Denver than it is in San Francisco. So that's something we certainly encourage companies to look at, as opposed to just coming to San Francisco or Palo Alto and knocking on doors out there. Again, part of that depends on what market they're looking for, and the other panels would probably know there's different venture capital communities around that focus on different markets and different types of products. But they find a small regional market that has that focus, and generally the people that have capital are going to be in that market. I mean, med tech. Sometimes we have people going to Minneapolis if they're a med tech company, because a lot of med tech companies up there. So there's a lot of capital up there to be going out, and the investors that are interested in med tech are going to be in Minneapolis because that's where so much technology is. So just don't look at the big markets, is what I tell people. Let's look at some secondary places you might be able to visit.
And how do they get in, though? Like, for those that don't have any connectivity to those markets, do you have a soft landing pad there for Victorian startups? Are there other groups, organizations that you can recommend for Australian companies that are thinking of raising capital in the US?
Yeah, well, Denver in particular, Austrade has a landing pad there. They're very closely connected with, I think it's the Denver landing pad. They don't have their own facility there, but they have a lot of connections there. So any companies can reach out to me, and I can connect them with Austrade if they're looking at Denver. Austin, not so much so. We have connections like with the economic development in Austin, so we can filter companies through there, and they can put them in touch with the Capital Factory or companies or places like that in those particular areas. But not that, to my knowledge, are there other specific landing pads for something like that. If ag tech, there's a landing pad down in Los Gatos that's still kind of in the Silicon Valley area, but that's one of the things that we do. A company comes to us, we might not know some specifically, say someone they want to go to Philadelphia, Atlanta, maybe for sports tech. That's our job, is to help them connect into that particular market through our network. So we help companies do that depending on where they want to look.
Beautiful. And thank you, Jeff, for
I'm going to
joining.
drop off now, Chris.
Okay.
Yeah,
See you around.
thank you very much for including me.
Thanks, Jeff.
So, Richard, what are your
Thank you.
thoughts in terms of raising capital internationally?
Well, I would start with the purpose. Why raise capital internationally? The first question an investor will ask outside your home market is, have you exhausted the investment community in your own market? So we always start with that. And my belief is that a broad capital base in many markets is important. But if you choose to raise money where there's a center of excellence, and as Brian had said, in med tech or sports tech or whatever, you're going to find that we would recommend and we would support and add value along the way is first secure customer capital in that market. So what I'm saying is find customers in that market, get to know that market. So when you do sit down with an investor in that market, you understand the market that they exist in. So we always say lead with customer capital. If you're going to secure capital in a new market, lead with securing customer capital or revenue in that market first, because you will have instant credibility for going into that market. And if I digress a little bit, I have a 20-year-old son who's raised a lot of money from Blackbird and Square Peg here in this market. His next step is a subsequent round with Sequoia or Excel in California. He already has a huge customer base in the U.S., which is growing quite rapidly, but he wouldn't have that credibility there unless he had secured a number of customers in that market first. So I'm a huge believer that lead with your commercialization in that market first. Just rocking up into a market where people have not heard of you is at times it just slows the process down.
Brian, is there a success story you've seen of a Australian company landing in Silicon Valley and being successful in the US market?
Let's take Aconex, for example. They landed and they worked really hard. I mean, they had some really good founders with really good vision. So they ended up setting up here in Silicon Valley. They actually had their global headquarters. I think it was down in San Carlos. And they were very active in raising funds, but they were very active in building their customer base. I think that was one of the keys for them is, to build that customer base. They got a contract for the Panama Canal reconstruction. And so that was a boost to them to be able to be successful here. And they grew their company where they had over $1 billion sale to Oracle a few years ago. But it kind of comes back to a point I kind of wanted to raise, Chris, that Richard mentioned, and something that I talk with entrepreneurs frequently about is, because I've had some advisors say, bootstrap as long as you possibly. I mean, work the hell out of the business and bootstrap and get along. As soon as you raise capital, then you have other considerations. So how important is for you from an investor is how that the companies have worked really hard to bootstrap it themselves? Because sometimes I see companies that just want to come and raise capital and they haven't tried to do any of that. So do you look at that before you consider talking with them or working with them?
Absolutely. As a matter of fact, I'll just take a step further on that. And a point to what Sean had said. And you asked the question, Chris, about how do you set valuations and what are your expectations? We actually do it kind of in the reverse fashion. So what capital does the company need to achieve their goals? And then what would an investor perceive a valuation? So say the company needs $2 million, but the investors probably think it's worth $4 million. Would we advise that founder at that early stage to give up half their company? The answer would be no. So we would look at all those non-dilutive sources of capital first And if we could optimize that mix of capital, maybe they only need to raise a couple 100,000 from an investor, and we can raise the other 1.8 million from those other 4 non-dilutive sources of capital. That's the best way to look at it. So we start with what are the true capital needs of the business, and then how do we build the right capital mix that allows that entrepreneur to still relatively be in control of that business. So hopefully that answers your question a little bit there, and the way we kind of historically looked at it. Yeah.
Absolutely. Sean, Asia, how active are you in Asia with your family offices over there? And, any insights for the companies that are raising, regionally here?
Yeah, look, it's I think the good thing about Asia is people in Asia, because of just the whole history and it's like new money there. They're probably the best allocators globally out of any investment community. If you have a look at Singapore, it's the Zurich of the East. There is so much money there. The tax incentives for family offices to deploy their capital there are just incredible. But because most of the wealth there has this history of, whether it be Japanese occupation or cultural revolution or economic uncertainty, they all think like refugees. So there's very little trust. And with that little trust, they look to allocate internationally and globally. And I think, again, this sort of follows a bit of Richard's point of view for returns, right? They're obsessed with, they want to see when they look at something to go, what's the multiple? Is it going to give me 5x, 10x, 20x, or something incredible? So they actually do less due diligence and move faster, right? So it's really, really interesting. And they do kind of, there's a club herd mentality around it, so that when they will move faster, they are really looking for co-investment rights and syndicated club investment opportunities. So they'll go, this family knows something, right? So, and they're doing something, right? So they'll do that. I've seen some really good secondary market activity around some Asian families that went in through, got investments into SpaceX, right? And everyone wants a piece of it, and that's just that mentality around it. But I think the other point here is which I strongly agree with, is when we're thinking about raising money in different markets, I won't touch US real estate investment opportunities being promoted to me in Australia, because I go, there's enough money in the US to fund real estate there. And you've got to ask the question, why are they coming here, right?
Yeah.
So, I think, Richard, you're saying, exhausted. Yeah. So I actually do agree, right, with the thought of, like starting the territory. So, we brought German science into business in Thailand. And Thailand has 70 million people, and there's a very significant high net wealth market. And if the first revenue and testing of the commercial validity of the model is going to be starting with Thai net high worths, so raise capital there first. It's the path of least resistance, and then as you sort of grow into other territories, is move around that. So I think it's always the measure of think global, think globally but act locally. When you break down the business, there's different risk appetites and different thoughts all along the way. So and it's, again, right, is for founders, is once you start a capital raise, 96% of your energy and attention is going to be going towards the capital raise, and your eye's going to turn off all the plumbing in the business. So I'm much more the fan of, is like grow, consolidate, validate, grow, rather than just trying to drive it all up in one way, because most startups fail because they can't fund their growth.
Got it.
Yeah.
Okay. Now we're going to wrap up in 15 minutes. Before that, I just wanted to do, I haven't tried this one before, a quick insight from you guys, each of you. I'm going to talk about maybe 5 industries, and I just want you to say one word or an insight for each one. Is that okay?
Yeah.
Let's see how we go. So let's start with you, Brian. AI, machine learning.
Boy, you gave me a hard one right off the bat there, Chris. I think I'm going to say upcoming.
Upcoming. Beautiful. Fintech.
Fintech. I'm going to go straight to cybersecurity.
Okay, awesome. And I'm just trying to see one of your topics you mentioned, defense.
Big opportunities. I'm sorry, that's 2 words, but opportunities.
A couple of words is fine. Richard. Okay, blockchain.
Blockchain. The future of society.
Deep. Deep here.
Yeah.
All right, I'm going to throw you a tough one here. Metaverse.
Early.
Early. Okay.
Yeah.
Nice.
Sustainability.
Our most important need.
Beautiful. All right, Sean. MedTech. Let's start easy. Healthcare.
Dangerous. Too much bureaucracy in it, so it's really dangerous.
Let's see. Throw SaaS, enterprise SaaS.
I think that's well established, proven.
Okay, and something that was big topic before. Now I don't know where. IoT.
Yeah. Look, I still think, huge opportunity. If I have a look at IoT in agribusiness, I still see huge growth. I think smart cities, huge growth. So a lot of growth, yeah.
Okay. Now, we asked a lot of different types of questions. Hopefully it was insightful for the audience, but we might have missed something that you're passionate about or you're working on. So who wants to start? Is there a topic that you want to share some insight with the audience when we're thinking about their journey on fundraising? Who would like to start?
I'll start. I'll start with an overarching trend that we see the world going through right now, and it is the age of the individual. And I think Chris touched on it earlier. We do believe the world's headed toward terminal velocity of 8 billion corporations at once. And our success in this new world order is either you will lead a movement or you will support that movement. And you may support that movement as an expert, and you may support maybe 10 movements. But you will either lead a movement or support a movement. And we're headed toward the age of the individual, where our collaboration skills and our creativity skills are going to be more forefront of mind than our ability to command and control an army into battle. So I would say, overall, we look for the trend. And so when I say blockchain could be the future, the decentralization of society is where we're headed. And we don't have to look very far to recognize that little countries today that already have inbuilt collaboration skills are navigating the world much more clearly than large countries that are stuck with huge momentum and everything else that they cannot actually adapt as quickly. And command and control will ultimately be the end of the strongman, in our opinion. Strongman is like the last gasp of a world that's going to the age of the individual. And the little countries of less than 5 million people are killing it right now because they have inbuilt collaboration skills and they're doing so well. So what does the age of the individual mean? Is terminal velocity is individual sovereignty. The idea of a geographic border being a construct is just that. You know, after World War II, we got to rewrite all those borders, but those borders are still constructs. At the end of the day, Brexit left the EU. Scotland may leave the UK. You know where this is all headed, that we're headed toward this individual. So we look at the decentralization of society and how that is going to impact the need for each of humankind's ability to either live a better life or survive extinction, or both. And so that's our thesis, and we're seeing it happen quite radically in social, business, and everything else.
Yeah.
There. Sorry.
I love it. No, I love it. The age of the individual from a decentralization standpoint, but leading with purpose.
Yes.
Beautiful. Brian, Sean?
Brian, you lead, mate.
Sure. I don't know what I want to follow, Richards. That was very, very, very broad and optimistic.
There's an amazing acronym to be discovered in that one.
Yeah, exactly. So, my perspective is a lot more granular than that. I have pages of notes, just what I've learned from Richard, Sean, and Jeff here, and I'm sure that the audience, the same type of thing. They probably has many notes as I have, because my perspective is, I pass on general information to companies and then get them to an advisor or a mentor, like the other panelists or all the mentors you have there, Chris, because I just think it's important to look at all those things, because the message that I would want to do or prepare for the audience is that they need to prepare. You talk about real estate, it's all about location. But if you're going to come to a market, especially like the US, and especially if you're raising capital, you have to be uber prepared by doing your homework, researching the market, evaluating competitors, target potential customers. I mean, that's client, and try to develop that even before you go for capital. And it comes down to developing a strong value proposition. And each of the other panelists have mentioned, that value proposition that has to be differentiated and unique. And then also understand your customers. What's their business like? What are their problems that you're trying to solve? And then do all this before you come to the US. Do this before you pick up the phone and try to call a venture capitalist. So my perspective is just do your homework while you're in Australia at home before you try to come to the US, where it's really competitive and expensive to do business. Just do your preparation in advance. And we're here to help you do that. Chris's group is here to help you do that type of a thing.
Amazing. Yeah, no, definitely. Execute first here, have local dominance, and then prepare and be very targeted to your audience and your investors, so you know who you're talking to and that they want to talk to you or use your service, etc. And yeah, I love that insight. Thanks, Brian.
Sure.
I might. I'll sort of try and think. I very much think and admire the comments that Richard made, and my congratulations to you. It reminds me that like in life, the best form of education is example, right? So I think always about what I like and what I like to do, and mentor my investee companies around is really comes back to corporate social responsibility. And I think corporate social responsibility is probably the most powerful element of a brand when we're thinking about it. And when we're talking about that CSR, it goes to I don't think enough companies think about the culture of the business. And I think, what's their Hippocratic oath towards all stakeholders, right? We have it in medicine, but if we think about AI and tech, and if I think of the future of that, I've spent a lot of time in China, and to see the application of social credits that's being driven by AI and facial recognition technology scares the hell out of me. So I think to think about, is being a good corporate social responsibility and a plan, and thinking about every stakeholder, its community, its employees, its customers, its suppliers, think about it holistically, will really differentiate your brand, and it'll make you an employer of choice. You'll have a superior business. You'll be a sustainable business. You're going to be differentiating. So I think it's those three magic letters is CSR is top of the way I think.
Amazing.
Beautiful.
Yeah, I have to say it, Richard, I do agree with you. I think what I see fundamentally, not what's wrong in the world, but it's always the 1% that gets the support, gets the jobs, are the influencers that just seem to make it. but what about the 99%? So my narrative is, how do we help the 99% as well? So I actually created an app called Ikigai Superpowers, and you can learn more later on. But the focus is really, how do we change the paradigm and help the 99% be successful? And that success could be based on the 4 principles of Ikigai. Do what you love, do what you're good at, your skills, do what the world needs, or do what you get paid for. And what we're attacking first is earning. You know, it's tough out there. How do we help the 99% earn? And so, you know, we have a bit of a purpose there, but, you know, I think that's another thing that is missing as well, is it's that sense of purpose. Okay. We're nearly out of time.
Yeah.
One final piece of advice specifically for fundraising, just a quick advice for the startups that are fundraising, and then we can sign off.
I will start with a little bit, is that there is some government assistance and grants available, whether it's statewide or Commonwealth guide. Start there in your funding journey. Sometimes that's a little bit easier to get to, and you know, if it's a grant especially. So start small as you prepare to go bigger, and then go back to my previous statement, is just prepare. You know, use all the resources, either from the New South Wales government or the Victorian government or Australia. Use those resources to prepare so that when you do come to market, you're ready to hit the ground running.
Yeah, and look, I just want to echo that. I think there is a lot of government grants. There is a company in Victoria that can help you. It's all about grant writing, right? It's called Grant Help. So, but there's others as well that could help you. So I love that.
Yeah, beautiful. Sean, do you want to go, or?
Yeah, look, I might just say it's look, it's dilution, right? I think it's always the thought of dilution, and it's thinking equity is the most expensive form of financing. So it is coming back to these things about bootstrapping and thinking about what are going to be some targets and milestones that you're going to successfully execute on that will drive a higher valuation, right? So the whole idea is to be only diluting the valuation arbitrage that you're creating, right? And you can keep giving away equity and with minimal impact in doing that. I think just the other one as well is because people don't give enough thought to it, because I've seen amazing businesses where the founder ends up with 1.3% of the capital stack at a time they then need even more funding. So it's really important to think about early up and having it there and getting the shareholder support and shareholder agreements around how like an ESOP, an employee pool, sits in there and gets refreshed to allow the talents, the key people that are driving the business to keep involved in the journey, because it's really, really hard for a founder to be motivated through the process of being diluted to a point that they really give up.
Amazing. Now, I'm going to put you on the spot. I took a lot of notes as well, Brian, like on my page. I'm still learning, and I'm going to be doing a weekly Ask the Expert and deep dive with individually you guys if you're interested. So I promise this is the last one. Brian, where can they get more information about what you're doing?
Well, if you're based there in Victoria, go to the Global Victoria website, and if you just put in Global Victoria, it'll take you to the website, and there you'll be able to find out any grants and programs that that's available to the governments. Plus, there will be contact details for people like myself. We have offices all over the world, and so if the U.S. isn't your place that you want to, it's not best place for you to do business, you'll have the contacts for China or Vietnam or Indonesia, wherever it is. So that's it, is globalvic.gov, and you can find all the information.
Amazing. Richard?
Beautiful. Catalyze.com, CATALLYZE.com. And we'd love you to reach out and join our exchange. At the very least, there's a lot of great information and great people there to help.
Amazing. Sean?
Anyone wants to contact me, write to me directly, either through you, Chris, or Sean@hatchprivate.com.
Perfect. Well,
Right.
thank you, Wholesale Investor, for having us. This has been a delight. A lot of expertise here. We believe a mentor's hindsight could be a startup's foresight. So you're hearing from their expertise. Look, at the end of the day, it's your journey. It's not ours. So you use this information based on what you think is best for your startup and apply it, because everyone's in different stages, different mindset. As my wife always says, be the best of you. Please stay safe and keep executing. Thank you very much for joining the panel.
Thanks, Chris.
everyone.
Thanks,
Thanks, everyone.
Investors.
Great to meet you
Great,
all.
thanks. Great to meet you too.